For more on where the record rally might go from here, let's bring in Oakmark Funds portfolio manager Bill Nygren. Bill, great to have you as always. We spent the last few days talking more about this secular growth concentration, and I wonder what you think that says about value, if it's a disappointment to Oakmark or an opportunity.
Well, when I hear you talking about all the big winners today, the one thing I know is we don't own any of them. So it's been a rough year for us trying to keep up with a market that's been so narrowly led by very high PE multiple stocks. I think the most interesting thing in the market today is that there are about 90 names in the S&P 500 that either lose money or sell at more than twice the market multiple. And there are about 80 that sell at less than half the market multiple. And at Oakmark, where we're trying to look out 5 years at the companies we think can have the largest increases over that time period, the balance swings very heavily today to the opportunities being in the low PE stocks.
Name a couple of them, and are any of them names that we don't often talk about with you, like a Capital One or an Alphabet?
Well, I think one of the tools that the management teams have at these low PE companies for self-help is share repurchase. So the companies that we're most excited about tend to be in relatively mundane industries where the managements have decided to return the capital they generate to the shareholders, either through dividends or repurchase. So one of our largest holdings is GM. And our opinion of Mary Barra went through the roof this year when in the first quarter they announced that they were going to be repurchasing 20% of their shares in the open market. And they announced earlier this week they've almost completed that already. And they're going to do another 11% of the company. It just seems like investors won't pay much for growth in EPS that comes from share repurchase. But GM's earnings will be going up about 40%. Earnings per share will be going up about 40% if they maintain flat net income just because of the decrease in the denominator.
I'm glad you brought them up because Morgan Stanley today takes note, best performing auto OEM year to date. While we cannot quantify the impact, we believe GM share buybacks are responsible for the majority, if not the entirety, of the share price performance this year. What does that say about the underlying business?
Well, I think GM management recognizes that they're in a relatively slow growth business. And I think that Morgan Stanley report is a good example of investors not wanting to pay for growth in earnings per share that comes from a reduction in the denominator. But we've seen so many examples of companies that have had disciplined buyback plans over multiple years and the tremendous impact that can have on share price.
Well, Bill, while we're on the subject, though, I mean, to Carl's point, the stock is up 33% this year. You don't think that's in any way reflective already of the expectations of a far smaller float?
Well, and after that large increase, David, it's up to a 5 times earnings multiple. So wow. we think that's still ridiculously cheap.
Yeah, five years worth of earnings seems relatively cheap. Yeah.
If they keep buying back 20% a year, we'll be the only shareholder in 2029.